Hello, finance experts. My name is Kathryn Bokun. I am a finance major at Southeastern Louisiana University. Today, we will be analyzing 10 equities across 2 industries on the basis of liquidity, solvency, efficiency, profitability, and market value measures. The first industry we'll look at today is healthcare services. This is an industry that is not currently represented in Southeastern's portfolio.
The following domestic equities were selected as our peer group based on market capitalization and industry revenues: Chemed Corporation, Almost Family, LHC Group, Amedisys Corporation, and Providence Services.
We'll use 3 measures of liquidity to assess the firms: the current, quick, and cash ratio. We want to ensure the firms can meet their short-term obligations. There's not a strong change between the current and quick ratio, indicating that they're not holding too much inventory, but the largest change occurs between the quick and cash ratio, which indicates that they have a lot of receivables outstanding. All firms appear to maintain positive values over the time period analyzed. My only concern is Providence in the year 2014. Their cash ratio is only 0.01, although they do appear to bounce back and they have a significant amount of receivables outstanding. Overall, it appears that the firms in this group maintain high levels of liquidity. Moving on to solvency. We also want to analyze whether or not the firm can meet their long-term obligations, so we want to look at how much debt they have and whether or not they can afford it. Whenever we look at their debt-to-equity ratios, Providence surges again in 2014. This is the same year they were experiencing some marginal liquidity issues. Also, Providence surges in 2016. Overall, Chemed, Almost Family, and LHC Group have increasing levels of debt, but nothing seems irregular here. Now we're going to continue analyzing the solvency on this slide as well. And in the top corner, we have a winners and losers chart that's going to summarize the information from the last slide, that debt to equity ratio. So the higher on the chart, the more debt these firms have. The amount of debt is also summarized in the leverage ratio. Here we have represented with a 5-year average. Providence definitely stands out. It has a value more than twice as much as the amount of their competitors. We're okay with that higher leverage or higher risk, but we will definitely expect a higher return on those investments. When we look at the EBIT to interest ratio, this is going to represent the company's ability to repay. So we want this ratio as high as possible. Both Amedisys and Providence have struggled with negative earnings over the last 5 years, so their ratio here is quite inconsistent. It looks like LHC has maintained a constant level, but Chemed has actually increased over the 5-year period in their ability to repay, which is a great indicator for an investment. Now, efficiency. Total asset turnover compares net sales to total assets, showing how much the company is generating in revenues for every $1 of assets. The group as a whole looks good. Amedisys and Chemed running very close over the entire period. Looking at the average over the last 5 years, Providence does have the highest value. However, the trend is very inconsistent, and again, we see issues around 2014 for them. Amedisys slightly outperforms Chemed in terms of efficiency.
For measures of profitability, the most important financial ratio is the return on equity. However, we want to break down this ratio using the DuPont decomposition method and see what's really driving the numbers. A preliminary look at the ROE value shows Chemed and Providence as obvious standouts. For every $1 of equity, $20.97 of net income generated for Chemed and $25.18 for Providence. If we go a level deeper, looking at leverage and ROA, Chemed is generating more net income from total assets than Providence, but Providence has a higher equity multiplier or leverage ratio. If we break down the ROA further into profitability and efficiency, we see that they have almost identical asset efficiency ratios, but Chemed is keeping more of their sales. Profit margin can be further analyzed as the tax burden, interest burden, and operating or EBIT margin. In terms of management and efficiency, companies have the most control over operating margin, which compares EBIT to net revenues. Chemed retains 11.34% of sales after operating expenses, while Providence only retains 0.55%. Overall, Chemed has the better profitability components, but Providence has the higher ROE. This is because of their increased leverage. So, the last profitability measure we'll look at is the sensitivity test. We can remove the risk tolerance or preference by calculating ROE for each firm with an assumed leverage of Providence, 2.95. Using the same leverage, Chemed would have an ROE of 37.02. Thus, we can conclude that Chemed is the best investment in terms of profitability. Also, remember that these values are strictly from the year 2016. It's also important to watch the company's performance over time to establish trends.
As we look over the 5-year period, Chemed is still the most consistent in terms of ROE and operating margin. The operating margin graph is remarkably close to the ROE graph, with the exception of Providence. They have a high ROE that's driven by leverage, but operating margins very close to zero. The last component we will analyze is market value measures. These values are from the fiscal year 2016, and note that some of these are absolute measures. When comparing different companies of different sizes, we use common size statements as a fair level of comparison to take into account the size of the firm. Chemed has the highest economic value added, $85.4 million. That's the value the company generated after accounting for their weighted cost of capital. Both earnings per share and dividends per share are common size statements. Chemed stands out with $8.38 of earnings per share and $1 of dividends per share. Actually, the only firm in the peer group that is paying dividends. When we look at the weighted cost of capital economic value added spread, only LHC Group and Chemed have positive values for all 5 years, which means the 3 other firms were losing money because they had a higher cost of capital than the return on their investments. Chemed stands out as the highest and most consistent relative to the overall competition. The top left, I have shown all 5 competitors' enterprise value multiple, which is enterprise value divided by EBITDA, so a similar ratio from price to earnings. Ametis has struggled with no to low earnings in several years, so it really skews their EV multiple. For this reason, we will omit it to fairly compare the other peers. LHC and Chemed have the strongest positive trend, but Chemed has held the better position over the time period analyzed and has definitely outperformed in the last year. Now, looking at price to earnings, it's a very similar story to the EV multiple. Chemed and LHC holding on to their strong positions. The price to book ratio shows Chemed is obviously outstanding from its peer group. The market sees value in this firm. And as that price to book value increases, that means the price or the present value of the expected future cash flows is expected to increase relative to what investors have already put into the firm.
Based on the analysis, I feel confident concluding that Chemed is the best performing equity in this category, but money talks. So let's do one last hypothetical example and assume that we invested $1,000 into each of these stocks in January of 2012, the same period that we've analyzed in this project. So here we have the share price, number of shares we could have hypothetically purchased, and the portfolio's value. Let's look at the return we would have gotten in this almost 6-year period. So we have the stock price today on November 20th, 2017, and the corresponding portfolio value calculated. Obviously, Chemed would have yielded the highest value in terms of dollars. In the last column, I have calculated the average and annual compounded return to achieve each portfolio's value. Again, Chemed stands out with almost a 30% compounded annual return. Now, the last portion of this analysis for this industry, we will look at a priced forecast for Chemed. The first method I used is a simple future value equation, assuming the stock value grows by the amount of their cost of capital. This calculation yields price predictions of $261.61, $287.30, and $315.67 for the years 2018, 2019, and 2020, respectively. The second method uses the firm's price to earnings ratio and expected earnings per share to predict the prices. The earnings per share was established on the pattern of dividends and dividend payout ratios for the last 10 years. This method yielded more conservative estimates, $245.37, $262.29, and $279.22. The third method uses a constant growth model and yields moderate estimates using a growth rate of 9.8423% and a cost of capital at 9.8472%. This yields estimates of $254.58, $271.01, and $287.43 for 2018, 2019, and 2020, respectively.
This concludes the analysis of our first industry, healthcare services. The second industry we will look at is infrastructure technology, which is currently represented in Southeastern's portfolio by both Microsoft and IBM. 3 other peers were selected based on market capitalization and industry revenue: Oracle, VMware, and Symantec Corporation. To simplify political and currency risk factors, only domestic firms were considered in selecting peers. Using the same liquidity measures, current, quick, and cash ratio, the peer group holds the same relative positions across all 3 measures, IBM being the least liquid, holding mainly inventory. The other 4 firms appear to mainly be holding cash. The concern with high cash ratios is that you can create an inefficiency by just sitting on cash and not investing it into projects. It's possible that what appears to be low liquidity for IBM is actually a strategy of efficiency. Let's take a look at solvency. IBM and Symantec have a run-up in debt in 2015 and 2017 respectively. VMware holds the lowest amount of debt, while Microsoft and Oracle have slowly increased their amount of debt over time. Long-term debt to total assets tells us the percentage of financed assets. It's also a measure of leverage that tells us where the firm is getting their money from. All 5 firms have seen a fairly rapid increase in creditor financing over the 5-year period. We've looked at how much debt each company has. Now let's look at whether or not they can afford it. Here we have the average levered ratio over the last 6 years. IBM stands out almost 3 times more than the amount of its competitors. When we look at each firm's ability to pay, they cover the interest expenses exponentially, with the exception of Symantec, who has struggled some years with negative earnings. In terms of efficiency, we will look at total asset turnover. This represents the value of sales for every $1 of assets, so we want this value to be as high as possible. IBM is head and shoulders above the peer group here. Remember what we mentioned initially? Earlier, their liquidity levels looked a little bit short, but this is evidence supporting the strategy of increased efficiency.
An initial look at ROE, and IBM definitely stands out with $73.04 of net income for every $1 of equity, and Microsoft with $29.37 of net income for every $1 of equity. As we look further, we can also see that IBM has a tremendous amount of leverage, and with more leverage comes more risk. IBM also wins when it comes to ROA, profitability. A further look shows Microsoft keeps more of its sales and profit margin, but IBM is more efficient with generating sales relative to assets. Actually, Oracle has a profit margin higher than Microsoft does, and in terms of minimizing cost, Microsoft outperforms IBM, but once again, Oracle is the best in this category. We have a significant difference in risk due to the variation in leverage. So let's look again at the sensitivity testing using a synthetic ROE, which will calculate the ROE for each firm, assuming it would have the same amount of leverage or debt as IBM. Microsoft comes much closer than before. However, IBM is the best investment in terms of profitability, even considering their higher degree of leverage. The values analyzed here from the fiscal year 2017, but it's also important to analyze these trends over time. Consistent with the previous slide, IBM dominates ROE and Oracle has maximized its operating margins.
The last area we will analyze are market value measures. IBM has almost twice the economic value added as compared to Microsoft. Economic value added is the value that the company has earned, taking into account their cost of capital. IBM also has earnings per share of $13.80. That's $10.50 higher than the next best peer in the group. Obviously, we would expect it to yield higher dividends per share, taking into account this increased level of earnings. Looking at the weighted average cost of capital, economic value added spread, this compares the company's return on invested capital to its weighted average cost of capital. Symantec and VMware both struggle with negative values, meaning that their capital cost them more than what they made on it. Although negative, IBM has the strongest overall trend in terms of weighted average cost of capital to the economic value added spread. Next, we'll examine the EV multiple, which is similar to the price-earnings ratio. This is the price that you would pay to take over a company relative to its previous one-year earnings. Both Symantec and VMware values are skewed because of their no to low earnings. However, Microsoft, Oracle, and IBM all have strong positive trends. I think it's important to remember how high IBM's earnings were initially. Those high earnings in the denominator will sometimes actually suppress the value of these ratios. Finally, we'll look at the price to earnings and price to book ratios. Microsoft has the most positive trend, but again, IBM's value is probably appearing lower than it actually is due to their very high earnings. Looking at price to book ratio, IBM has actually decreased quite a bit over the 5-year period. Microsoft, on the other hand, has had a very strong positive trend. Both the price to book and the price earnings ratio are market value measures that let companies know how the market values their firm. Now, these numbers have said a lot, but we'll finish this analysis with the same hypothetical example that we did with the healthcare industry.
If we invested $1,000 of January 2012, what would the return on that investment look like today? The same process as before, calculate how many shares you can buy, the initial portfolio value, and the current portfolio value. Then solve for the compounded annual rate of return. Based on this criteria, the best investment in the infrastructural technology sector over the last 5 years would have been Microsoft, earning 21.21% annually, 10% more than the second best performing competitor.
We'll compare some of the key ratios from before: your ROE decomposition, the price to earnings over time, and the stock price performance over the 5-year period. Microsoft has had a slightly higher ROE, but is using considerably more leverage. Microsoft has the larger operating margin and profit margin than ChemEd, but ChemEd has the greater asset efficiency and the higher ROA value. Finally, if we look at the hypothetical ROE, using the leverage of Microsoft, ChemEd would actually have the higher overall ROE value. Secondly, when we look at the price to earnings ratio over the 5-year period, ChemEd has outperformed Microsoft up until 2015. Since then, their values have been almost identical. Finally, we will look as if we had invested into each of these firms 5 years ago. ChemEd would have yielded the higher return, 29.28% compounded annually. For these reasons, I would recommend investing into the ChemEd Corporation. In summary, today we analyzed 2 industries on the basis of liquidity, solvency, efficiency, profitability, and market value measures over a 5-year period. We concluded that ChemEd and Microsoft were the best investments in the healthcare and infrastructure technology industries, respectively. We also used 3 pricing methods to forecast the stock price of ChemEd out for 3 years: the future value approach, the price to earnings approach, and the constant growth approach. And our final conclusion was that ChemEd was the best overall investment. I hope you've enjoyed watching this video. Thanks for watching.